next speaker, Paul Dean. Paul Dean is a senior economist with ANZ. He's flown all the way over from Melbourne to speak with us today, so we thank you very much for joining us today, Paul. Paul is a fellow alumni of Melbourne University, the same as myself. Paul grew up on a farm in Victoria, then went to Melbourne Uni to study agricultural science and economics. He worked at Woolmark and then moved on to ANZ, so he's a senior agricultural economist and he spends his days analysing all of the agricultural markets and trying to give us all a good idea of where prices might be going. So it is my great pleasure to introduce Paul, who's going to talk to us about economics and agricultural markets today. Thanks, Paul.
Thanks, mate. Good morning, everyone. I must say, it's slightly uncharted territory for me to follow a futurist for an economist. I'm sure there's a good joke where if you stuck an economist and a futurist on a desert island, I'm not sure what the outcome would be. It was very interesting hearing that this morning. Look, I am going to, again, economists, one of their faults is we do look backwards, tend to look backwards a little bit. So my focus, I will try and give you, I guess, our views on sort of more of a 1 to sort of 2 to 3 year outlook across a variety of areas. I have also worked in the Australian economics team within ANZ, so I thought I'd give you also just a bit of a rundown initially on how we're seeing the Australian economy and I guess the implications for interest rates and the Aussie dollar as well. So the title of that presentation, Bottom Fishing, I mean, one of the key themes, certainly in agricultural markets, as you're only too aware, is, you know, what we're looking at from an analyst perspective is where's the bottom in the market, given what's happened over the last sort of 4 or 5 years, and now we're moving out of this sort of peak price phase. The same with the Australian economy to an extent. Again, the Australian economics team looking at where's the bottom in interest rates, and again our FX guys with the changes that are going on in commodity markets, where's the bottom of the Aussie dollar as well. So the Australian economy, this is essentially the essence of, if you like, of what is going to happen over the next couple of years, or what we're faced with in the Australian economy. So, as we all know, we've had, I guess, the mother of all investment booms as far as commodity or mining investment goes. So, if we go back, say, to the start of last decade, major projects and investment in infrastructure in Australia was generally running at about $10 billion a year. It'll peak this year at around $100 billion. But the key issue over the next few years for Australia is essentially a lot of that investment. We're at the peak now, and we see it drop away quite significantly over the next few years. So by 2015-16, we end up with major investment back to, say, $30 billion. So we've got a $70 billion gap over the next few years, if you like, that's getting pulled out of the economy and a drag on the sector. So this is one of the things that, if you like, the economics team and the RBA and how we manage that transition, if you like, from the mining to the non-mining sector, and how we really need that part of the non-mining sector of the Australian economy, if you like, to fill the gap. Unfortunately, it's not at the moment. So these two are consumer and business confidence in both those for the Australian economy. And so even though we've had, significant rate cuts, we're still not really seeing any major change to either consumer or business investment. And in fact, the latest business survey here in Australia shows that profitability for businesses in general is the worst as it has been since the GFC. So part of that, we think, is with the fall in the Australian dollar, that businesses are struggling to sort of pass on those higher import costs through to the consumer. So that is squeezing business profitability to extent. But again, both those sectors, consumer and business, sentiment's poor. Certainly from the business perspective, we're not going to get business investing sort of when sentiment's that like that. The labour market, again, from an interest rate perspective, the RBA's got two mandates essentially, looking at the labour market, what's going on in employment, and also inflation or price stability, if you like. Here again, the news isn't great. You can see that probably the bottom chart here is the key one, this section here. So what we've got here is monthly change in job numbers. So if you look at based on current population, sort of new people coming into the workforce, generally we need to be creating about 15,000 jobs a month in the Australian economy just to keep the unemployment rate stable, to match the new, I guess, workforce coming in on a monthly basis. At the moment, it's only running at about a couple of thousand jobs, so you can see the trend here in the last few months particularly is well below that sort of 15,000 job mark. But also, if you look at the colours there, the composition of the labour market, so the orange bars are part-time and the dark blue is full-time. So what's worrying, I guess, for the market or from the Australian economy perspective is most of the job growth that has been there over the last sort of 6 to 8 months has all been part-time. Again, not a great outcome. I mean, from a consumer spending perspective, you want full-time jobs, which gives job security and that sort of thing. So not surprisingly, the RBA has been, I guess, cutting interest rates further, and that's the blue line you can see there. So we've essentially got interest rates now just below the GFC crisis levels. And the other line there in the orange is the unemployment rate. So again, you can see unemployment picking up here. I guess generally the view is here that we've still probably got another 6 or 9 months of unemployment increasing. And again, that's one of the reasons we think that the RBA's or interest rates have still got maybe another cut left in the market. So that's some of the, I guess, most of the bad news. There is some good news. The Australian economy is starting to respond to the lower rates. And one of the key ones is the housing market. So we all like to talk about housing prices. So what we've got here in the blue line is the Australian auction clearance rate, if you like. So you can see middle of last year the clearance rate was running at around 50% at auction across Australia. It's now up to 66%, and what we've done there, it's now up to 66%. And what we've done here in the orange line is effectively look at the change in house prices. So clearance rates at auctions and the housing market is generally a pretty good lead indicator of what house prices are going to do on a forward basis. So, we've got house prices at the moment growing around 4% per annum, and again, there's probably further gains to come over the next 6 to 12 months. So our property team thinks that, for example, I think Perth house prices are going to grow by about sort of 5 to 7%. Over the next 12 months or so. So there are some positive signs on the housing side. We need rising house prices to stimulate housing construction and residential construction, and that's essentially one of the things that the RBA is trying to kickstart, if you like, the non-mining sector through residential property and construction. So what does all that mean for interest rates? So the cash rate, the RBA is at 2.5% at the moment. Again, my apologies there, this hasn't been updated since they cut this month. So the actual rate's here now at 2.5%. Our forecast is for another rate cut in October. We don't think they'll go in September. Historically, they only go back to back, I guess, when there's major sort of GFC type crisis. We're not sort of at that point. And it's 4 days before an election, so it's unlikely we see a rate cut in September. So we're looking at October for another rate cut, which is the bottom of the bottom of the cycle. But you'll see our forecast there, and I guess the key point of our forecast is that we think interest rates are on hold at these levels for a prolonged period. So given this big fall away in mining investment, and given broadly the Australian economy growth is looking probably sub-trend over the next 12 months, we think rates will be on hold for, say, another sort of 12 or 18 months. And that's fairly unusual. We think there are some reasons for it, but typically the bottom in interest rates only lasts, in the cash rate only lasts for sort of 6 to 9 months, whereas this time around we think that's going to be notably longer. The Aussie dollar. So again, there's a couple of drivers of the Aussie dollar, but certainly commodity prices is a key one. So what we've got here is the blue line is the Aussie US dollar, and the orange line is Australia's terms of trade. So that's essentially looking at Australia's export prices versus import prices. The key, agriculture is a small component of that. It's essentially all bulk commodities, so iron ore, coal, and some of like gold and some of those other markets. What we think, there's a couple of things here from a commodity market perspective. We're certainly past the peak phase in prices, so commodity prices in general peaked in Q1 2011. Agricultural commodities essentially peaked at the same time, as it turns out. But we're now well into sort of, I guess, a downtrend into broader commodity markets. From a bulk commodity in particular market, the next 2 or 3 years we are going to see, already seeing significant supply coming into the market, which will add further pressure to prices. And then I guess we've got the structural reforms going on in China, which again probably means that demand out of China for hard commodities is probably not going to be as strong as what it has been over the previous 4 or 5 years. So all that means essentially is our forecast for the Aussie is lower from here. So we've got 88 US cents by the end of this year, and then sort of 85 towards the end of 2014. So certainly our view is that the Aussie has got further to fall. That sort of 85 level, interesting enough, when I look at agriculture and, I guess wheat growing profitability and competitiveness, we generally need to see the Aussie back to that 80-85 for Australian wheat growing to be sort of back to its more normal competitive levels. I mean, we've ran the numbers, but if you look at, say, the way the Aussie dollar moved against our key competitors in Australia, so whether it's Black Sea region, the US, and some of those other markets, the Aussie dollar was actually up 55% against competing export markets for Australian wheat about 12 months ago. So that means your competitiveness was actually had declined by over 50% in the space of 3 or 4 years, if you look at the way the Aussie dollar had appreciated. So, consistent with, I guess, that the Aussie certainly was overvalued on a number of fronts back at 105. And again, from an agricultural perspective, we think if we can get the Aussie back to that sort of 80-85, then we'll see a lot of sectors regain sort of competitiveness on that side. Agriculture. Obviously, it's been a pretty turbulent 4 or 5 years from a price perspective. This chart here essentially shows, if you look at the drivers of agriculture, it's essentially supply driven. So unlike hard commodities, demand and what happens in China tends to be fairly important. For agriculture, it tends to be more about supply. And what happened over the last decade is essentially, and this is not just in grain markets, but if I showed you these same sort of charts across sugar, cotton, we essentially had global stocks of all agricultural commodities run down over the last decade. So just to explain this chart, so this is looking at wheat ending stocks globally versus price. So along the bottom here we have weeks of supply, if you like, or ending stocks of global wheat expressed as weeks of supply. So if we go back to sort of 2000, 2001, at the end of those seasons globally, the world had about sort of 19, 20 weeks of supply of wheat sitting in reserve. What we had you can see here over the course of the following 7 or 8 years, we had that stock run down. So ending stocks in 07, 08 got down to around 12 weeks of supply. So effectively, if the world stopped producing wheat at that point, we had about 12 weeks left before the world ran out of wheat. And you can see here across most markets that's quite a strong correlation with overall. So prices on the vertical here, and the numbers in here represent years. So it's quite a strong correlation, and we've got corn up here on the smaller one. Corn actually shows an even stronger correlation, if you like, but a very strong correlation with where prices are at globally versus wheat stocks. So for commodity markets or agricultural commodities, we're in for wheat in particular. You can see here, stocks are still reasonably tight, and what will essentially the market's still not out of the woods, and corn's the same. We're seeing global stocks of corn rebuilt slightly, but we're still in this phase where global stocks need to get rebuilt probably over the next 2 or 3 years. That's assuming they can, to really, I guess, take the risk out of the market that if we get a major supply shock like we got last year, say in the US corn crop, that volatility is greatly reduced. So from a pricing perspective and in your businesses, you think about the next 2 or 3 years, if we do get supply shocks, the market still will react, but on a 3 to 5 year view, if global stocks do get rebuilt and that trend continues, then price is arguably going to fall back to more sort of cost of production, not cost of production levels directly, but you'll see some of your marginal producers perhaps get squeezed out of the market. So we're still in this phase where stocks are tight. If we look forward, I guess, And I just want to talk a little bit about what's lost, I guess, on the wheat market to an extent, and I'll talk about corn a fair bit today, but essentially what's driven corn prices over the last few years in the wheat market has been, it's been quite significant. So normally wheat will trade at, say, a $40 or $50 US a tonne premium to corn, and what we saw last year was the opposite, where essentially wheat traded flat versus corn. And the key reason for that was the drought in the US Midwest. But just to put this, the US corn crop in perspective, so, you know, in a normal year, this year the US corn crop will be at 350 million tonne crop. So Australian wheat crop this year will be about, say, 25, somewhere around there. So the sheer scale of that crop, it has enormous impact across the global grain market. And the orange bars there represent the amount that they export. So you can see, you know, obviously Australia is quite significant from a wheat market perspective and influential on the export side, even though we produce a reasonably small amount. But you can see in the US there, normal year will still supply about 45 million tonnes of corn into the global market. So the chart here is looking at US corn yield. So the blue line is the trend line, and the orange was the actuals over the last 15 years or so. Again, just the magnitude of the drop with the drought last year. So it was a 1 in 30 year drought in the US, where we saw US corn yields drop 20%. So the probability of a repeat of that this year was always going to be reasonably low, and therefore one of the key reasons we've seen prices particularly come off over the last quarter or so. This is essentially what prices, this is an agricultural price index, so this is grains, oilseeds, sugar and cotton. Again, just some perspective on, so you can see the three major price spikes there. To an extent, they're all driven partly by different commodities. But why we're saying the peaking in agricultural commodities was 2011, or the Q1 2011 period here, is that was when essentially we had the whole agricultural complex at record highs. And that was the extreme point where, if you like, none of the agricultural commodities could get a free lunch by stealing acreage off different commodities, if you like. So we had that massive pressure on the supply side, where all markets were very tight, and so that fed through, and sort of agricultural commodity prices were highly correlated at that point. You can see the good news is here, and it doesn't show up that well, but we're actually about here now. So most of the downside, in our view, has now been priced into the market, and particularly now that we've gone through the key period with the US corn crop and pollination period there. A lot of that risk has come out of the market. So we think prices are stabilising at around this level. And from a perspective of, I guess, over the last, again, this is in US dollar terms, but essentially that means prices have grown by about 10% per annum over the last 8 years, each year. So that's the sort of perspective in US dollar terms of the price gains that we've seen across the market, where we think it will settle. So that's near term. Look, China and what's going on through Asia on the demand side is still in its infancy, I guess. And when you look back, when you go back here and you see those three price spikes, I think what's exciting for agriculture is China. It hasn't really been about China. Unlike what we've seen in, say, hard commodities, where China has been, very influential on influencing prices in those markets over the last decade. Agriculture, really, it's only been the last few years where the impact of China has started to come into the market. And this is illustrated by these charts. So what we're looking at here is China's net imports or exports for individual sectors. So for animal protein, so above this line here, China was a net exporter, if you like, of animal protein up until about sort of 06, 07. For the last 3 or 4 years, we've seen a significant swing to a net importer. And the same for grains. Again, it was only in the last few years that we've seen China swing to a net importer across corn, wheat and rice. And if I do these charts for, say, sugar, a variety of markets, we're seeing exactly the same trend. So all of it's pointing to that, if you like, China has largely been self-sufficient in food up until the last few years, but you look at things like this and what's going on with prices, and there's clear signs that, I guess, China's days of self-sufficiency in food are essentially over. from a price perspective in China, just as an illustration on what's going on with sort of where prices are at globally. Again, China has a policy for a number of reasons of supporting domestic prices across all their commodities, essentially, agricultural commodities in China. So the dark blue line here is the wheat price in China. Again, this is in US dollars a tonne. So the last six years or so, China's domestic wheat price has essentially doubled from $200 a tonne to $400. And one of the reasons for that, it's not the only reason, but the orange lines here are the domestic support prices. So China will set, prior to sowing, essentially a guaranteed floor price for the farmer each year. And so you can see there on the orange line, each year that tends to increase anywhere from about 5 to 10%, which provides support to the market. What's, I think, crept up on when you look at that and you factor in, China switching to a net importer of grain, and if we look at, say, this is APW here out of WA, landed into China. Essentially, there's about a $100 disparity opening up now with where current prices are at. So, not surprisingly, and obviously, we've been hearing about it, but it's very, from a price perspective, there's a massive opportunity and attractiveness for China to be importing not only Australian wheat but global wheat. So, this sort of trend will continue. So, it's very unusual that China doesn't raise domestic prices sort of by 5 or 10%. Again, this is going on in corn, this is going on in sugar markets where they're bringing increasingly in price support mechanisms. And in a lot of instances, in sugar, for example, their domestic sugar price is double what the world price is. So these trends, again, as China swings to a net importer, this year we think China will import, 15 million tonnes of grain. We think sort of 3 to 5 years, we'd expect that to be about sort of growing to 25 million tonnes of grain. Excuse me. So, again, this price disparity, if we look at it in Indonesia, again, Indonesia doesn't grow wheat, but if you look from a rice market perspective, again, Indonesia, I haven't put in, but again, they do similar things with price support for rice in Indonesia. But essentially, you can see there, in the space of 3 years, the price of rice increased by $300 a tonne US. So wholesale rice price in Indonesia now is about $700 a tonne. Again, $400 disparity opening up now between Aussie wheat or global wheat prices and domestic prices up through Asia. So again, these trends they're not going away. You argue that their domestic prices are only going to continue to rise. And as their reliance on imports increases, again, this isn't a 1 or 2 year thing, but on a 3 to 10 year view, these sort of trends are very supportive for prices, for grain prices globally. So they're the sort of things we're seeing up through Asia. I won't go into, how am I going for time? I won't, again, so on the demand side, Asia is very positive. This is just a slightly different perspective. Just a caution, if you like. We talk a lot about the positive aspects from Australia and the ability to supply Asia, but again, we do have some key competitors, obviously, and Brazil's a really interesting market when you break down and look at it. What we've done here is looked at the top 5 or 6 exporters for each of the key commodities, and you can see that from a wheat perspective, certainly we don't compete directly with Brazil. But from a corn market, and again, grain markets are increasingly linked between corn and what is happening in wheat. If I go back a few years ago, Brazil would probably not have made it into the top sort of 5 or 6. And if we look at what's happened with Brazil's probably one of the few regions where, on a number of commodities, where higher prices have encouraged production. And one of the things we're thinking about this year, which is a new dynamic in the market, if you like, is Brazil's increased what they call their second crop production of corn this year. So again, in a couple of years they've gone from producing 60 million tonnes to 80 million tonnes of corn. Again, a lot of that is going to go into the export market. And the second crop is harvested around sort of May and June. So a lot of that will come into the second half, if you like, of the year, again, which probably coincides with, I guess, the Aussie harvest. So while not competing directly, what it does point to is that and especially with the US this year, their corn crop looking reasonable. We could have both the US and Brazil trying to market corn quite aggressively in that sort of Q4 this year, again, coming into our harvest. And again, we haven't really seen this from Brazil before, where Brazil has a significant amount of corn to come in through that end of year window around our harvest time. So more probably an issue for sort of lower quality, feed grade types, where we think the feed market could be particularly under pressure through that Q4 this year. One of the positives is fund positioning, if you like, or speculative leveraged fund positioning is very short agricultural market. So essentially what we're talking about here is, if you like, to stereotype is hedge fund, if you like, coming into Chicago wheat, buying, being either a buyer or seller. And what we tend to find is that while on a medium-term view they don't influence the price, certainly on a week-to-week, month-to-month basis, big moves in their positioning, in leverage fund positioning, if you like, in agricultural markets will put significant pressure on prices. The positive here, as you can see, is they're essentially the shortest they've been in agricultural markets in the better part of 4 or 5 years. So, again, consistent with our view, a lot of the downside risk has been taken out of markets on a short-term basis as well, because these funds are now well out of the way, if you like. So, in fact, and probably one of the reasons we've seen, rises even in the last few days, is that given how short they are, when they do come back in and, if you like, cover their shorts, that tends to see perhaps some little short-term surges in price that we're going to see from time to time. But again, this is positive that some of the big moves we've seen in grain prices over the last 4 or 5 years has been these funds liquidating on a 1 or 2 week horizon. And given that's out of the way, that's a positive from that sharp move is largely out of the way, or the risk of that is gone. Just to US corn crop, just again, the US is, we get overkill on the available condition of pretty much everything in the US. But again, we get weekly crop reports on what's going on in the US. So this is looking at the percentage of the US corn crop in good to excellent condition. Over a number of years. So the green is this year. You can see last year the end of July last year, only 26% of the crop was rated good to excellent condition, and again, that's where we had yields down 20%. What this is basically saying is, again, and one of the reasons, if you like, grain markets globally have come under pressure over the last month or so, is that while there may be some minor issues in some of the states in the US, on a broad sense, crop conditions are such, and again, it's going to be open. The USDA cut US corn yield slightly, which put some pressure on prices a week or so ago. Again, you'll probably find this year that, give or take 3 or 4%, which isn't going to be enough to ultimately change the sort of broad view of where prices are at currently. That the corn yields are going to be somewhere around sort of close to trend, either up or down a couple of percent, but not enough either way to really see a sharp improvement or deterioration in prices for them. Just to, again, talking about corn and sort of pricing wheat on a longer term basis. So this is looking at front month Chicago corn and wheat. So the shaded area here again is the premium, if you like, wheat trades at over, what have we got there over the last, in fact, if you go back 20 or 30 years, it's pretty similar that wheat tends to trade around that sort of anywhere from $30 to $40 a tonne premium. So, what's interesting now is, and again, wheat fundamentals, I will say, wheat fundamentals are significantly better, increasingly where the corn market's at, if you like, and especially from a global perspective, medium-term protein wheat, I think the fundamentals, again, there are quite supportive. So more 11.5%, 12% protein. I think the story there is quite positive over the next 12 months. Again, moving back into the low protein, probably again the feed market situation may mean that market comes under a little bit more pressure. But again, what we're seeing here is normality return, if you like. Wheat's moved back to a sort of $40, $50 a tonne premium to corn. And one of the ways we're thinking about where the prices end up this year at harvest for Australia is essentially looking at modelling the corn price. And I won't bore you with all that, but essentially what our forecasts are, with the Aussie dollar back to sort of 88 US cents by the end of this year, around harvest time, we get a track price here in Australia at around $250 a tonne. Now that's assuming sort of flat basis. And again, WA basis obviously tends to be much stronger than the East Coast or SA. But, again, at current prices on offer somewhere around that sort of 270, 275 market. So some potential minor downside, but again, on a broad theme, we think most of the downside's priced into the market. On that note, I think I'll leave it there and throw it open to questions.
Can you hear me? Yep. You sort of touched on the labour market very slightly. And I guess one of the challenges as agricultural producers and the broader manufacturing community is that we've got a very regulated labour market in Australia, but we're exporting into a very global market where, in essence, there's a very competitive labour market. I'm just wondering if the decision by the Holden workers recently is probably a indication that we may look forward to some wage deflation in Australia, so we can regain our competitiveness.
Look, I don't know about wage inflation. I think probably the best we can hope for is wages stay flat. I mean, and again, the exact numbers, but even the most recent sort of wage, even though, again, the Australian economy has been sort of below trend for probably better part of sort of 12 months or so now. Wage growth still in general on ABS numbers is still something like 2 or 3%. Again, that's across the broad sector. I was talking to a construction company yesterday, but they are, and again, they're in the business of, their maintenance business and looking at sort of diesel fitters and all that sort of stuff, but they are seeing significant sort of change, obviously, with the way the mining sector's come off and sort of, the freeing up of that market. So whether you actually see, price declines, I'm not sure, but certainly availability is increasing, and for the regional sector as a whole, and I guess for Australian agriculture, I think that is a positive. You would probably argue again for highly regulated markets, where you've got union and things like that, it's probably hard pressed to see deflation. But perhaps on a private enterprise sort of agreement, then you may well see that, or already seeing that probably in the market.
You commented on Perth residential property prices growing 5 to 7% in the next 12 months. You also commented on mining, construction reducing every year for the next 5, I think. How do you see Perth residential property prices tracking for the next 5 to 10 years?
Look, in a broad sense, and again, I'm outside the Australian economics team now, but I'm sort of that sort of longer term view. But again, what we're seeing now on the housing market is essentially all interest rate driven. And while we talk about the negative aspects of the mining investment coming off, I guess from Australia's perspective, obviously part of the story is while investment's coming off, exports, if you like, are ramping up significantly. So, there's that different phase, if you like, on the mining side. So that's not necessarily means that the WA economy is going to, fall in a hole or anything like that. But I guess where I was going with short term, so we've got, this period probably over the next 6 to 12 months where house prices do respond to these particularly low rates. But look, on a 3 to 5 year view, which is probably as much as I dare to go, given it's not my area these days, again, given where levels are and affordability and some of those issues, when rates do start to go up, you would have thought that's going to sort of curb house prices. And I know in most of the markets, probably on a 3 to 5 year view, we probably think house prices maybe grow at sort of 2 to 3% a year after that, so sort of keeping up with inflation. But, again, some of these markets are reasonably fully valued, if you like, on a broad sense.
I can't resist. Rob Sands, I'm Eco Consultant. I liked your graph about the weeks of supply and the prices. but you can tell it's an economist talking when he says there's a good correlation versus a scientist. So does that correlation improve if you just looked at the export countries, the major exporters? Because that was a big run.
Yeah, look, there's better. Look, wheat's a little bit different, and again, I won't go back to it, but look, the chart, there's sort of two different levels there. Part of this, I guess, has been skewed by the corn market, where you go back to 2007, essentially wheat was driving its own fundamentals. Then we had the influence, if you like, of the broader commodity spike and corn coming into the mix and all those sort of interrelationships. So that has meant for wheat to an extent, it's one of the reasons if you look at wheat price over the last 4 or 5 years versus stocks, it took that sort of level up where corn basically came in and provided some support on that aspect. But look, there are better ways to make those correlations stronger, and you're right. I mean, one of the troubles when you look at wheat ending stocks or grain ending stocks, not so much now, but certainly over the last decade, a lot of those stocks have been in India or China. They're quite captive. Arguably, they're not freely available, and you do get a different perspective if you look, for example, at ending stocks of the major 5 or 7 exporters. We do look at that analysis, and it shows slight differences to an extent, but the broad sort of idea is sort of there.
Lawrence Carsley, Flamenco. Just a question outside of your talk. Looking at China's production of cotton and stocks on hand, what are your thoughts on its effect on likely wool price in the next couple of seasons?
On the wool price? Okay. Okay, so for those of you that, and again, it's sort of a really interesting aspect. Cotton, for those of you who don't know, cotton spiked to 200 cents a pound, which was the highest price in 150 years in that 2011 period. Basically, Chinese mills ran out of cotton. That was one of the key reasons. As a result of that, the Chinese government implemented a reserve, or if you like, a floor price for their growers to try and maintain production, but also try and maintain some price stability. The net result of that is over the last 2 years, China's been buying. Last season, they bought about 90% of their cotton crop and put it in state reserves. Again, their motivations for why they're doing that, I would say it's actually more about food security. So it's probably a very easy way for them to, if you like, store land or land bank. If you store grains or soybeans, you've got to rotate them every sort of 6 or 12 months, whereas in parts of China, they can actually, where they've had, where it's cold, they can actually store cotton for like 7 years. So I think it's quite a cost-effective, and China's yields of cotton aren't very good anyway by global standards. So they're actually much better to use that land probably to grow corn or wheat or not so much soybeans. So I think a lot of it is about this transition where they don't want to be growing as much cotton as they do. They're trying to do that gradually and by controlling the market. So that sort of gives, I guess, some of you some perspective on what's going on. But China's got probably about 1.5 years worth of cotton in their state reserve based on their sort of current domestic mill use. So there's a large amount of, and again, when you look at the cotton market, it's got the worst fundamentals. You look at a global stocks basis, cotton should be at about 60 cents, not 90 or so where it's at the moment. But again, that's part of that where all that stock is essentially captive in China, and you go to the major exporters and they're essentially out of cotton. So within all that aspect, cotton on a fundamental on a global basis is overvalued, but again you've got this distortion with what China's doing. When or how China manages that, you would have thought they probably don't have much more capacity to buy from even a storage point of view. When I was over in China a few years ago, the general view was that they probably had about the ability to store about 7 million tonnes of cotton in their state reserve with warehouses and things. At their peak this year, they had about 12 million tonnes of cotton. So, again, we think this year, probably, the risk is this year it's a day of reckoning where they won't be able to buy all their, they'll only be able to, well, they may buy all this year's cotton crop in China, but then they'll have to dump it all back onto the market. And so when that happens, and if China's not, as a result, China's not importing any cotton for 6 months or so, there's a risk there that cotton prices do break significantly. And from a wool market perspective, and again, I don't look at it that much these days, it's probably not going to be a great outcome. But again, I think wool's increasingly, the wool to cotton ratio and some of those measures, I don't think are as important as what they were probably a decade or so ago. But in saying that, yeah, if cotton falls sort of 20 or 30% at some point in 12, 18 months' time, that would put pressure on wool prices.
Okay, if we've run out of questions, we might leave that there. So please join me in thanking Paul very much for that.